The use of a tax treaty by persons either individual or a legal person to obtain indirectly a treaty benefits that are not available directly, and that was briefly the definition of the tax treaty shopping. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. So, treaty shopping would happen when residents of a state that is not party to a particular treaty and then use it to obtain benefits indirectly through a different state, which we call it intermediary jurisdiction or a conduit country. It is a way of seeking benefits from a tax treaty by structuring a business transactions or investments through an intermediary jurisdiction which normally would have a little or no substantive economic activities, and this for the purpose of only taking advantage of favorable tax provisions found in bilateral tax treaties between countries. Well, so how it would be structured or designed? Let's simplify. Let's assume that we have a resident of state X who does not have a tax treaty with state Y, and then created a conduit company in state Z trying to derive benefits under the tax treaty between state Z and state Y. And here let's just highlight what do we mean by the conduit company. The conduit company is an entity with a legal structure that is typically established as intermediary just to take advantage of tax treaty benefits, such as reduced withholding tax rates on dividends, interest, or royalties, being provided by tax treaties or domestic tax laws. So here the taxpayer would use the conduit company to shift income from the source country to the ultimate beneficial owner of that income, and that's the essence of treaty shopping, which is to bring the taxpayer within the personal scope of a treaty, trying to derive its benefits that would not be available to it as a non-resident person. So the goal here is to reduce or eliminate the withholding taxes, capital gains taxes, or other taxes that would apply to the income or the transactions in the absence of this tax treaty. Well, so now talking about treaty shopping, then we would highlight that tax treaty shopping would have different features or types. For instance, when the beneficial owner of the treaty does not reside in the countries where the bilateral tax treaty is applied. Also another type here, when the conduit company has minimal economic activities in the jurisdiction where it is located. Well, now, one of the most important points to be highlighted here in this video that treaty shopping would be viewed as abusive act, and normally it is debatable as it results in a reduction of tax revenues for the countries involved and may be seen as a form of tax avoidance. And that's why many countries have taken some steps trying to address the misuse of conduit companies and to combat treaty shopping by including the anti-abuse provisions in their tax treaties or domestic tax laws. Those rules were designed to prevent tax treaty benefits or to apply further requirements when conduit companies are used mainly in a manner just designed to minimize the tax burden or to avoid taxes rather than being used for legitimate business purposes. Good. That was a quick overview about one of the most interesting international tax topics. More interesting tax topics are coming. So like and subscribe if you would like to see more videos, and thanks for watching TaxGate.